Today's guided example comes from Chapter 1. In Chapter 1, we were talking about different types of costs a manufacturer might have. So for this example, we're going to look at Summer Springs Incorporated. We have a lot of information from them, from direct labor to raw materials purchased to inventories. But the first thing we need to know is, what is our time period? The time period could be a year, it could be a month, it could be a quarter. We need to know the time period so that we can determine what is beginning inventory and what is ending inventory. According to this, it looks like everything is September, so we see that we have September 1st and September 30th. So that tells me that the time period is the month of September. So if I'm doing the month of September, that means my beginning inventory will be September 1st and my ending inventory will be September 30th. If this was for the year, then my beginning inventory would be January 1st and my ending inventory would be December 31st. So that's one way that we can tell the difference, because we're going to need to know both beginning and ending inventory. First, we're going to start with direct materials used. Direct materials used are the materials used during production that can be directly traced to the item, which is why they're called direct materials. Direct materials come from the raw materials inventory account. So we need to start first with beginning raw materials inventory. And we said that was for September 1st. So we'll look at raw materials inventory on September 1st, and that's $5,000. To this, we want to add any raw material purchases we've made during the month. According to our instructions, the raw materials purchased were $8,500. Next, we will subtract what we didn't use. That's going to be our ending raw materials inventory. So ending raw materials inventory, we see here, is $10,000. So we'll subtract that because we want to subtract what we already have, and that's going to give us the amount of raw materials used. So my raw materials used are $3,500. Raw materials used can include both direct and indirect materials. Direct materials go straight into work in process. Indirect materials go into factory overhead first. We will know if there's any indirect materials because the problem itself will say that there are indirect materials. And in this case, we do not see any indirect materials. I'm going to go ahead and include it so that you know that this has to be done. We're going to subtract any indirect materials. Indirect materials in this example are 0. So that means my direct materials used will be $3,500. Next, we go to direct labor. Direct labor is anything that can be directly traced to a product. It will go directly into work in process. Direct labor will typically be given to you, and the direct labor in this problem is $12,500. It could be given to you in dollars, or it could be given to you in a pay rate per hour, and then they tell you the number of hours that they work, so be aware of that. You might see it different ways. Then we have factory overhead. We can refer to this as factory overhead, overhead, manufacturing overhead. It all means the same thing. These are indirect costs necessary to create the product. So any indirect cost necessary to create the product. This will include indirect labor, indirect materials, and any other factory-related expenses. So keywords you're looking for here are factory or production, things like that. So if we look in our information, we've already used direct labor, we've already used direct materials purchased, and then we have factory utilities, factory supervisor salary, factory rent. All of those have the keyword of factory in them, so we need all of those. We also have administrative expense and marketing expense, but those do not have the word factory in them and are not related to creating the product, so they are not factory overhead. So it's only going to be those 3 items. So factory utilities, factory supervisor salary, and factory rent. The utilities were $900, the salary was $1,000, and the rent was $2,000. We're going to use those three calculations, direct materials, direct labor, and factory overhead, to get cost of goods manufactured. Cost of goods manufactured is the cost of completing the items. So this is when it moves from finished goods, or from work in process to finished goods. So we're going to include the cost of direct materials, the cost of direct labor, and the cost of factory overhead. And that gives us our total manufacturing cost for the period. That is not our cost of goods manufactured, that just tells us what we did this period. So the cost we added this period was $19,900. To this manufacturing cost, this gets added into work in process. So we're going to add what's already in work in process. So we want beginning work in process, which again is going to be our September 1st. Our September 1st work in process is $30,000. So that'll tell us what we started the period working with, and then we're going to subtract what we did not finish. And what we did not finish will be our ending work in process. And our ending work in process on September 30th was $35,000. So my cost of goods manufactured is $14,900. Now we move on to cost of goods sold. So we've had the cost of goods manufactured. This is what we completed this period. This cost of goods manufactured gets moved into finished goods. What we sell gets expensed as cost of goods sold. So we need to figure out what it is that we sold. So to do this, we will calculate beginning finished goods inventory, which will be our September 1st amount. So our beginning finished goods inventory on September 1st was $20,000. To this, we're going to add our cost of goods manufactured, or what we completed this period. And then we're going to subtract what we didn't sell, which is going to be what remains in ending finished goods inventory. We did not sell $28,000 worth of merchandise. So my cost of goods sold is $6,900. We will take this cost of goods sold over to the income statement to determine if we made any profit or loss on these sales. For this case, we also want to know our product and period costs. Product costs include anything necessary to create the product. That's going to be our direct materials, our direct labor, and our overhead. So we'll have direct materials, direct labor, and our overhead. Again, overhead can be called overhead, factory overhead, or manufacturing overhead. Any is just fine. You'll notice this is also our total manufacturing cost for the period. Period costs are anything that is incurred by the business but is not related to creating the product. These are going to be our selling, general, and administrative expenses. Selling expenses are going to be anything related to selling a product. That will be advertising, marketing, sales salaries, sales commissions, depreciation on any store equipment will all be considered a selling expense. Administrative expenses would be anything related to the office. It would be office supplies, it would be depreciation on office building or office equipment, it would be administrative salaries, things along that nature. In our example, we've used direct labor, raw materials purchased, factory, utilities, salary, and rent. We have not used the administrative and the marketing because those are period costs. So we have administrative expense of $3,000, and we have marketing expense of $500. So my period cost would be $3,500. We would use this on the income statement to figure out net income. So hopefully this example gave you an idea of how we use these costs, how we calculate them, and look to the demo to see how these all apply in an income statement.